Welcome to Corporate Snooze, slow stories of business innovation, corporate history, and other related subjects, chosen specifically for their sleep-inducing qualities. So relax, unwind gently, and let the subject matter do the rest. In this video, we explore the history of accounting. The need to keep track of things is as old as human society itself. Before there was writing, before there were cities, people needed to remember quantities. How many animals were in a herd? How many baskets of grain had been stored? How many days until a season changed? Memory alone was sufficient for small groups and simple situations. But as groups grew larger and activities became more complex, memory became inadequate. Something more permanent was needed. The earliest forms of record keeping were physical. A shepherd, watching over sheep, might use pebbles, placing one pebble in a container for each animal. At the end of the day, the pebbles could be counted to verify that no animals were missing. This was not yet accounting in any formal sense. It was simply a method of tracking, of creating a physical representation of a quantity. But it established a principle that would underlie all future accounting, the creation of records that could be consulted later. Notches carved into sticks or bones served a similar purpose. Each notch represented a unit of something. The object with its notches became a record. It could be kept and referred to over time. Archaeological evidence shows that such tally sticks were used in various parts of the world thousands of years ago. The marks were simple, often just straight lines. The sophistication lay not in the marks themselves, but in what they represented, the agreement that these marks stood for something else. Tokens were another early form of record keeping. Small clay objects shaped into different forms, each form representing a different commodity. One shape might represent a measure of grain, another might represent a jar of oil, a third might represent a sheep. These tokens could be grouped together, stored, and counted. They were portable records, physical manifestations of quantities and transactions. The use of tokens was particularly developed in ancient Mesopotamia, the region between the Tigris and the Euphrates rivers. This was one of the earliest places where agriculture became intensive and where cities developed. Agriculture produced surpluses. These surpluses needed to be stored, tracked, and distributed. Temples and palaces became centers of administration. They collected goods from the surrounding areas and redistributed them to workers, priests, and officials. The scale of these operations required systematic record keeping. Tokens were placed in clay envelopes. The envelope was a hollow ball of clay. The tokens representing a transaction were placed inside. The envelope was then sealed. Often, marks were made on the outside of the envelope, indicating what was inside. This way, the contents could be known without breaking the seal. The sealed envelope served as a secure record. If there was later a dispute about what had been agreed, the envelope could be broken and the tokens counted. Over time, a transformation occurred. If the marks on the outside of the envelope could indicate what was inside, then perhaps the tokens themselves were unnecessary. The marks alone could serve as the record. This realization led to the development of writing. Instead of placing tokens in envelopes, scribes pressed marks into soft clay tablets. The marks represented the same things the tokens had represented: a mark for grain, a mark for oil, a mark for sheep. Numbers were indicated by repetitions of marks or by specific symbols. These clay tablets were the earliest written records. Many thousands of them have survived, baked hard by time or by fire. They were not literary texts. They were administrative records. Lists of goods received, lists of goods distributed, inventories of stored items, records of debts owed and debts paid. The content was mundane, but the innovation was profound. Information could now be recorded in a form that was compact, durable, and unambiguous. The cuneiform script that developed in Mesopotamia was complex. It used hundreds of different symbols. Learning to read and write cuneiform required years of training. Scribes were specialists, members of a professional class. They worked for temples, palaces, and wealthy merchants. Their role was to create and maintain records. They documented transactions, kept inventories, and prepared accounts. Their work made possible the administration of complex organizations. The records kept by Mesopotamian scribes were detailed. A tablet might list the names of workers, the tasks they performed, and the rations they received. Another might record the quantities of wool received from shepherds and the quantities of cloth produced by weavers. Yet another might track the movement of goods between different storage facilities. The tablets were organized and stored systematically. Archives have been found containing thousands of tablets, arranged by date or by subject. The purpose of these records was practical. Administrators needed to know what resources were available. They needed to ensure that workers received their rations. They needed to detect theft or loss. They needed to plan for future needs based on past patterns. The records provided the information necessary for these tasks. They were tools of management, enabling the coordination of activities on a scale that would have been impossible without written documentation. Egypt developed its own system of record-keeping around the same time. The Egyptians used papyrus, a material made from reeds that grew along the Nile. Papyrus was lighter and more flexible than clay tablets. It could be rolled up for storage. Writing on papyrus was done with ink made from soot or other pigments. The script used was hieratic, a cursive form of hieroglyphics, faster to write than the formal hieroglyphic characters. Egyptian administration was extensive. The pharaoh's government collected taxes, organized labor for public works, and managed the distribution of grain during times of shortage. All of this required records. Scribes kept accounts of tax payments, recording the amounts owed and the amounts paid. They tracked the labor contributed by villages to the construction of temples and pyramids. They monitored the levels of grain in state granaries. The annual flooding of the Nile was central to Egyptian life. The flood deposited fertile silt on the fields, enabling agriculture. But the flood also washed away boundary markers. After the waters receded, surveyors had to re-establish the boundaries of fields. This work was documented. Scribes recorded the measurements and the names of the landowners. These records were used to calculate taxes, which were based on the area of land cultivated. Record-keeping in Egypt, as in Mesopotamia, was in the hands of trained specialists. Scribes were educated in schools attached to temples or government offices. They learned to read and write, to calculate, and to prepare the various types of documents required by the administration. The role of scribe was prestigious. It offered a path to advancement within the bureaucracy. The importance of literacy and numeracy in administration meant that scribes occupied an important position in society. The records created by these ancient scribes were not accounts in the modern sense. They did not distinguish between different types of assets or track changes in wealth over time. They were primarily inventories and transaction logs, but they established patterns that would persist: the recording of quantities, the documentation of transactions, the organization of records for future reference. These practices would be refined and elaborated over the millennia that followed. Trade created additional needs for record keeping. Merchants who traveled long distances to buy and sell goods needed to track their transactions. They needed to know what they had paid for goods, what they had sold them for, and what profit or loss they had made. They needed to keep records of debts, of amounts owed to them by customers, and amounts they owed to suppliers. These records were often kept on portable materials, tablets or scrolls that could be carried on journeys. Partnership arrangements in trade also required records. Two or more merchants might pool their resources to finance a trading expedition. They needed to record what each had contributed and agree on how profits would be divided. Disputes could arise if records were unclear or incomplete. Written agreements and accounts provided a basis for resolving such disputes. They made cooperation possible between parties who might not have complete trust in one another. The Greeks developed commerce extensively. Greek merchants traded throughout the Mediterranean and beyond. They established colonies and trading posts. They dealt in grain, wine, olive oil, metals, slaves, and many other goods. The scale and complexity of Greek commerce required systematic record keeping. Accounts were kept of transactions, inventories, and debts. These accounts were often maintained by slaves or freedmen who acted as managers or stewards for wealthy individuals. Greek city-states also kept public accounts. Revenues from taxes, tribute, and the operation of mines and other state-owned resources were recorded. Expenditures on military forces, public buildings, festivals, and administration were documented. These accounts were sometimes inscribed on stone and displayed publicly. The purpose was to demonstrate that officials were managing public funds properly. The transparency was a form of accountability, though the term would not be used in quite that way for many centuries. Roman administration extended over a vast area. The Roman Empire at its height controlled territories from Britain to Mesopotamia, from the Danube to the Sahara. Administering such an empire required extensive record keeping. The Romans developed sophisticated systems for tracking taxes, military supplies, land ownership, and legal transactions. Their records were kept on wax tablets, papyrus, and parchment. Scribes and clerks maintained files in government offices throughout the empire. Roman law placed emphasis on written documentation. Contracts were recorded. Property transactions were registered. Wills were drafted and witnessed. The legal system relied on these records to establish rights and obligations. The existence of a written document was often decisive in resolving disputes. This legal emphasis on documentation reinforced the importance of keeping accurate records. Roman merchants and landowners kept accounts of their business activities. Estate managers maintained detailed records of agricultural production, recording the quantities of grain, wine, and other products harvested, the amounts sold, and the revenues received. They tracked expenses for seeds, tools, labor, and other costs. These records allowed the owner to assess whether the estate was profitable and to identify areas where improvements might be made. The Roman military maintained extensive records, lists of soldiers, their units, their ranks, their length of service, inventories of weapons, armor, and supplies, records of pay distributed and rations issued. These records were necessary for managing an army that numbered in the hundreds of thousands. Commanders needed to know the strength of their forces. Quartermasters needed to ensure that supplies were adequate. Administrators needed to process retirements and transfers. All of this depended on accurate record keeping. The fall of the Western Roman Empire in the 5th century disrupted many aspects of Roman life, including record-keeping practices. The scale of administration declined as centralized government collapsed. Trade diminished as roads became unsafe, and political fragmentation made long-distance commerce more difficult. The use of writing declined, especially in the western parts of the former empire. Literacy became less common outside of the church. The Christian church became the primary institution that maintained literacy and learning. During the medieval period, monasteries had scriptoria where monks copied manuscripts. These manuscripts were primarily religious texts, but they also included works on various practical subjects. Monks kept records of the lands owned by the monastery, the rents and dues owed by tenants, and the expenditures of the monastic community. These records were necessary for managing the monastery's resources. Manorial estates in medieval Europe were largely self-sufficient agricultural units. The lord of the manor owned the land. Peasants worked the land, owing labor services and payments in kind to the lord. The management of a manor required records. The steward or bailiff who managed the estate kept accounts of the work performed by the peasants, the quantities of crops harvested, the amounts paid to the lord, and the expenses incurred in running the estate. These accounts were reviewed periodically by the lord or his representatives. Medieval accounts were often quite detailed. They might list every item of income and expenditure over the course of a year. The income might include rents paid in money or in kind, fees from courts held on the manor, profits from the sale of surplus crops, and various customary payments. The expenditures might include wages paid to hired laborers, costs of maintaining buildings and equipment, purchases of supplies, and payments to the lord's household. The accounts were presented in narrative form, with each item described in a sentence or a few sentences. The purpose of these accounts was to demonstrate that the steward had managed the estate properly, that he had collected what was due and spent money appropriately. The account was a record of stewardship. The steward was accountable to the lord. The written account provided the basis for this accountability. If the account showed a deficit, the steward might be required to make up the difference from his own funds. If the account showed a surplus, the steward might be rewarded. As trade revived in medieval Europe, merchants again needed to keep accounts. Italian city-states, particularly Venice, Genoa, and Florence, became centers of commerce. Merchants from these cities traded throughout the Mediterranean, bringing goods from the East to Europe and exporting European products in return. The volume and complexity of this trade required systematic record-keeping. Merchants developed methods for tracking their transactions, inventories, and financial positions. Early merchant accounts were often chronological journals. Each transaction was recorded as it occurred. The entry noted the date, the parties involved, the goods or money exchanged, and any terms or conditions. These entries provided a complete history of the merchant's business activities. If a question arose about a particular transaction, the merchant could consult the journal to find the relevant entry. The journal was useful, but it had limitations. Finding information required searching through many entries. If a merchant wanted to know the current balance with a particular customer, he would have to go through the journal and add up all the transactions with that customer. This was time-consuming and prone to error. A solution was to transfer information from the journal to a ledger organized by account. Each customer would have a page in the ledger. Each type of expense would have a page. Each type of inventory would have a page. The ledger provided a systematic way to organize information. The development of double-entry bookkeeping was a significant innovation. In double-entry bookkeeping, every transaction is recorded twice, once as a debit and once as a credit. The system is based on the principle that every transaction affects at least two accounts. If a merchant buys goods for cash, the inventory account increases and the cash account decreases. The increase in inventory is recorded as a debit. The decrease in cash is recorded as a credit. The two entries balance, ensuring that the accounts remain consistent. The origins of double-entry bookkeeping are not entirely clear. The method seems to have developed gradually in northern Italy during the 13th and 14th centuries. Merchants and bankers began using it to keep track of their increasingly complex transactions. By the 15th century, the method was well established among Italian merchants. It provided a systematic way to record transactions, to track assets and liabilities, and to calculate profit or loss. The first printed description of double-entry bookkeeping appeared in 1494. A Franciscan friar named Luca Pacioli included a section on bookkeeping in a mathematics textbook. Pacioli did not claim to have invented the method. He was describing a practice that was already in use among merchants. But his description made the method widely known. The book was printed and distributed throughout Europe. Merchants and bookkeepers in other countries learned about double-entry bookkeeping from Pacioli's work. Pacioli described the use of three books: a memorandum book, a journal, and a ledger. The memorandum book was used to record transactions informally as they occurred. The journal was a formal chronological record where each transaction was written out carefully, specifying the accounts to be debited and credited. The ledger contained the individual accounts, organized by type. Entries from the journal were posted to the ledger so that each account showed all the debits and credits that affected it. The ledger accounts were balanced periodically. Balancing involved adding up all the debits and all the credits in an account and calculating the difference. If the debits exceeded the credits, the account had a debit balance. If the credits exceeded the debits, the account had a credit balance. Some accounts naturally had debit balances, such as asset accounts. Others naturally had credit balances, such as liability accounts. The balances provided a summary of the financial position at a particular moment. One of the key features of double-entry bookkeeping is that the total of all debit balances must equal the total of all credit balances. This is because every transaction involves equal debits and credits. If the totals do not match, an error has been made. This self-checking feature makes double-entry bookkeeping more reliable than single-entry methods. Errors are easier to detect and correct. The ability to calculate profit or loss systematically was another important benefit of double-entry bookkeeping. In a single-entry system, profit might be estimated by comparing the value of assets at the beginning and end of a period. But this method was imprecise. It did not account for withdrawals made by the owner or additional capital contributed. In double-entry bookkeeping, revenue and expense accounts track the components of profit. At the end of a period, these accounts were closed, and the difference between revenues and expenses was transferred to the capital account. This provided an accurate measure of profit or loss. The spread of double-entry bookkeeping was gradual. It was adopted first by large merchant houses and banks, organizations that had the resources to employ trained bookkeepers and the complexity of transactions that justified the effort. smaller businesses continued to use simpler methods. But over time, as commerce expanded and as more people were trained in bookkeeping, the method became more widespread. By the 18th century, double-entry bookkeeping was standard practice in most of Europe. The growth of joint stock companies created new demands for accounting. A joint stock company had multiple shareholders. These shareholders were not involved in the day-to-day management of the company. They needed information about how the company was performing, whether it was making a profit, and what their shares were worth. Accounting provided this information. Financial statements were prepared showing the company's assets, liabilities, revenues, and expenses. These statements were presented to shareholders at regular intervals. The preparation of financial statements required standardization. Different companies might use different methods for valuing assets or recognizing revenues. This made it difficult to compare financial statements across companies. Gradually, conventions developed about how particular items should be treated. These conventions were not formal rules initially. They were simply practices that became common because they were seen as reasonable and useful. Auditing emerged as a way to verify the accuracy of financial statements. An auditor is an independent person who examines a company's records and confirms that the financial statements are a fair representation of the company's financial position. Auditing was initially used mainly for detecting fraud. Shareholders or creditors who suspected that a company's managers were dishonest might hire an auditor to investigate. Over time, auditing became a regular practice, even when no fraud was suspected. The purpose was to provide assurance that the financial statements could be relied upon. The Industrial Revolution increased the scale and complexity of business. Factories required large investments in machinery and equipment. They employed many workers. They produced goods in large quantities. Managing an industrial enterprise required detailed information about costs, production, and efficiency. Accounting systems were developed to provide this information. Cost accounting tracked the costs of materials, labor, and overhead for each product or production process. This allowed managers to identify which products were profitable and which were not. Depreciation became an important concept in industrial accounting. Machinery and equipment wear out over time. Their value declines. Depreciation is a method of allocating the cost of an asset over its useful life. Instead of recording the entire cost in the year the asset is purchased, the cost is spread over the years the asset is used. Each year, a portion of the cost is recorded as an expense. This provides a more accurate picture of profit because it matches the cost of the asset with the revenues it helps to generate. The development of railroads posed particular accounting challenges. A railroad company spent enormous sums building tracks, bridges, and stations. These expenditures occurred over several years before the railroad began earning revenue. How should these costs be accounted for? Should they all be recorded as expenses immediately, resulting in large losses during the construction phase? Or should they be treated as assets, with the cost being depreciated over the life of the railroad? Different companies made different choices, leading to confusion and criticism. Governments began to regulate the accounting practices of certain industries. Railroads, utilities, and banks were subject to government oversight. Regulators required these companies to file financial reports and to follow specified accounting methods. The purpose was to protect investors and the public. Standardized accounting made it easier to compare companies and to detect financial problems. Regulation also aimed to prevent companies from using misleading accounting to hide losses or inflate profits. Professional associations of accountants were formed in the 19th century. The first was established in Scotland in the 1850s. Similar organisations were soon formed in England and other countries. These associations set standards for admission, requiring members to pass examinations demonstrating knowledge of accounting principles and practices. They also developed codes of ethics, specifying the professional responsibilities of accountants. Membership in a professional association became a mark of competence and respectability. The role of accountants expanded beyond bookkeeping. Accountants became advisors to businesses, helping with financial planning, tax matters, and organizational structure. They were called upon to investigate frauds, to value businesses for sale or merger, and to testify as expert witnesses in legal proceedings. The profession diversified, with some accountants specializing in auditing, others in taxation, and still others in management consulting. The complexity of modern business organizations required more sophisticated accounting systems. Large corporations had multiple divisions, each with its own operations. Consolidated financial statements were needed to show the overall financial position of the entire corporation. This required combining the financial information from all the divisions, eliminating transactions between divisions to avoid double counting. The process was intricate and required careful attention to detail. The distinction between capital expenditures and operating expenditures became important. Capital expenditures are costs incurred to acquire or improve long-term assets. They are recorded as assets on the balance sheet and depreciated over time. Operating expenditures are costs incurred in the day-to-day running of the business. They are recorded as expenses in the period they are incurred. Misclassifying expenditures could distort profit figures, making a company appear more or less profitable than it actually was. Revenue recognition is another area where accounting practices developed. When should revenue be recorded? When an order is received? When goods are delivered? When payment is received? Different choices could lead to very different financial statements. Accounting standards were developed to provide guidance. Generally, revenue is recognized when it is earned, and when collection is reasonably assured. But applying this general principle to specific situations required judgment. The matching principle states that expenses should be recognized in the same period as the revenues they help to generate. This principle underlies much of accrual accounting, the method used by most businesses. In accrual accounting, transactions are recorded when they occur, not when cash changes hands. Revenue is recorded when earned, even if payment has not yet been received. Expenses are recorded when incurred, even if payment has not yet been made. This provides a more accurate picture of financial performance than cash accounting, which only records transactions when cash is received or paid. Inventory valuation is another area requiring accounting judgment. A business holds inventory, goods that it intends to sell. The cost of this inventory includes not only the purchase price, but also costs such as transportation and storage. When goods are sold, the cost of those goods is recorded as an expense called cost of goods sold. But if prices are changing, which cost should be assigned to the goods sold? Several methods exist. The first-in, first-out method assumes that the first goods purchased are the first ones sold. The last-in, first-out method assumes that the most recent purchases are sold first. The average cost method uses the average cost of all goods available for sale. Each method can produce different profit figures. Accounting standards specify which methods are acceptable and require companies to disclose which methods they use. This allows users of financial statements to understand how figures have been calculated. Comparability is improved when companies use similar methods or when differences in methods are clearly disclosed. The balance sheet is one of the primary financial statements. It shows a company's assets, liabilities, and equity at a particular moment in time. Assets are resources owned by the company. Liabilities are obligations owed to others. Equity is the residual interest, the difference between assets and liabilities. The balance sheet reflects the accounting equation. Assets equal liabilities plus equity. This equation always holds because of the way transactions are recorded in double-entry bookkeeping. The income statement, also called the profit and loss statement, shows revenues and expenses over a period of time. The difference between revenues and expenses is the net income or net loss. The income statement provides information about the company's performance. Did it generate a profit? How do current results compare to previous periods? Are revenues growing? Are expenses under control? These questions can be answered by examining the income statement. The cash flow statement shows the cash generated and used by a company over a period. It is organized into 3 sections: operating activities, investing activities, and financing activities. Operating activities include the cash effects of transactions that enter into the determination of net income. Investing activities include purchases and sales of long-term assets. Financing activities include borrowing, repaying debt, issuing stock, and paying dividends. The cash flow statement provides information about liquidity and financial flexibility. Financial ratios are used to analyze financial statements. A ratio compares 2 figures from the financial statements, providing a measure of some aspect of financial performance or position. The current ratio, for example, compares current assets to current liabilities, measuring the company's ability to meet short-term obligations. The debt-to-equity ratio compares total liabilities to equity, measuring financial leverage. Return on assets divides net income by total assets, measuring how efficiently assets are being used. Dozens of ratios can be calculated, each providing a different perspective. Notes to the financial statements provide additional information that is not easily included in the statements themselves. These notes explain the accounting policies used, provide details about particular items, and disclose information about risks and uncertainties. The notes are an integral part of the financial statements. Understanding a company's financial position requires reading both the statements and the notes. The development of generally accepted accounting principles, often abbreviated as GAAP, provided a framework for preparing financial statements. These principles are not laws, but they are widely followed because they are seen as best practices. They have been developed over time by accounting standard-setting bodies, which bring together accountants, auditors, business people, and academics to deliberate on accounting issues. In the United States, the Financial Accounting Standards Board issues accounting standards. Other countries have their own standard-setting bodies. International standards have also been developed to facilitate comparability across countries. The conceptual framework underlying accounting standards identifies the objective of financial reporting, the qualitative characteristics that make information useful, and the elements of financial statements. The objective is to provide information that is useful to investors, creditors, and others in making economic decisions. Useful information has certain characteristics. It is relevant, meaning it can influence decisions. It is reliable, meaning it is free from error and bias. It is comparable, meaning it can be compared with information from other companies or from other periods. It is understandable, meaning it can be comprehended by users who have a reasonable knowledge of business and accounting. The elements of financial statements are the basic building blocks: assets, liabilities, equity, revenues, expenses, gains, and losses. Each of these elements is defined in the conceptual framework. The definitions guide the classification and measurement of items in financial statements. For example, an asset is defined as a resource controlled by the entity as a result of past events, and from which future economic benefits are expected to flow. This definition helps determine what should be recognized as an asset and what should not. Accounting for complex transactions requires detailed guidance. Leases, for example, can be structured in various ways. Some leases are essentially purchases of assets financed by borrowing. Others are simply rental agreements. Accounting standards specify how to determine whether a lease should be treated as a purchase or as a rental. Similar detailed guidance exists for pensions, stock options, derivatives, and many other transactions. The measurement of assets and liabilities can be done in different ways. Historical cost measures an item at the amount paid when it was acquired. Fair value measures an item at the amount it could be sold for, or the amount that would have to be paid to settle an obligation. Different measurement bases provide different information. Historical cost is objective and verifiable, but may not reflect current economic reality. Fair value is more relevant, but may require estimates and assumptions. Accounting standards specify which measurement basis should be used for different types of items. Consolidation. Accounting is used when one company controls another. The parent company and its subsidiaries are treated as a single economic entity. Consolidated financial statements combine the financial information of the parent and subsidiaries, eliminating transactions between them. This provides a comprehensive view of the entire group. Consolidation requires careful elimination of intercompany transactions to avoid double counting. It also requires dealing with minority interests, the portion of subsidiaries not owned by the parent. Foreign currency translation is necessary when a company operates in multiple countries. Transactions in foreign currencies must be translated into the company's reporting currency. The translation uses exchange rates, which fluctuate over time. Gains and losses can arise from changes in exchange rates. Accounting standards specify how these translation adjustments should be recorded and reported. Tax accounting is distinct from financial accounting. Tax rules are set by governments and are designed to determine how much tax a company owes. Financial accounting rules are designed to provide useful information to investors and others. The two sets of rules often differ. A company may recognize revenue or expense in one period for financial reporting purposes and in a different period for tax purposes. These differences, called temporary differences, give rise to deferred tax assets or liabilities. Management accounting focuses on providing information for internal decision-making. Unlike financial accounting, which is concerned with reporting to external parties, management accounting is concerned with helping managers plan, control, and make decisions. Management accounting reports are not subject to external standards. They can be designed to meet the specific needs of managers. Common management accounting tools include budgets, variance analysis, and cost-volume profit analysis. Budgeting is the process of preparing detailed plans for future periods. A budget specifies expected revenues, expenses, cash flows, and financial position. It provides a benchmark against which actual results can be compared. Variances, the differences between budgeted, admitted, and actual amounts, are analyzed to understand what caused the differences. Were sales higher or lower than expected? Were costs more or less than anticipated? Understanding these variances helps managers take corrective action and improve future planning. Cost behavior is an important concept in management accounting. Some costs are fixed, meaning they do not change with the level of activity. Rent is a fixed cost. Whether production is high or low, the rent remains the same. Other costs are variable, meaning they change in proportion to activity. Materials used in production are variable costs. If production doubles, the cost of materials doubles. Understanding cost behavior helps managers predict how costs will change and make decisions about pricing, production levels, and resource allocation. Break-even analysis determines the level of sales at which total revenues equal total costs. At the break-even point, the company is neither making a profit nor incurring a loss. Knowing the break-even point helps managers assess risk and set sales targets. If actual sales are well above the break-even point, the company has a margin of safety. If actual sales are close to the break-even point, the company is vulnerable to losses if sales decline. Standard costing is a method of cost accounting that assigns expected costs, called standard costs, to products. Actual costs are then compared to standard costs. Differences, called variances, are analyzed. Favorable variances occur when actual costs are less than standard costs. Unfavorable variances occur when actual costs exceed standard costs. Variance analysis helps identify areas where performance is better or worse than expected and guides efforts to improve efficiency. Activity-based costing is a more refined approach to cost allocation. Traditional costing methods allocate overhead costs based on a single measure, such as direct labor hours. Activity-based costing recognizes that overhead costs are driven by multiple activities. It identifies these activities and allocates costs based on the extent to which each product or service uses each activity. This provides more accurate cost information, particularly in environments where products differ significantly in complexity or in the resources they consume. Transfer pricing is an issue in organizations with multiple divisions. When one division provides goods or services to another, a transfer price must be set. This price affects the profitability reported by each division. If the price is set too high, the supplying division appears profitable while the receiving division appears less so. If the price is set too low, the opposite occurs. Transfer pricing can affect managerial decisions, such as whether to buy internally or from external suppliers. It can also have tax implications when divisions are in different countries with different tax rates. Performance measurement in organizations goes beyond simple profit figures. Balanced scorecards incorporate multiple measures, including financial metrics, customer satisfaction, internal process efficiency, and learning and growth. The idea is that focusing solely on financial performance can lead to short-term thinking and neglect of factors that contribute to long-term success. By including a broader set of measures, organizations can better align activities with strategic objectives. Internal controls are procedures designed to ensure the accuracy and reliability of accounting records and to prevent fraud. Segregation of duties is a key control. The person who authorizes a transaction should not be the person who records it or handles the related assets. This makes it more difficult for a single individual to commit fraud without detection. Other controls include requiring approvals for certain transactions, conducting regular audits, and implementing systems that automatically check for errors or unusual patterns. Computerization has transformed accounting. Manual bookkeeping, which involved writing entries in physical ledgers, has been replaced by computerized accounting systems. These systems store data electronically, perform calculations automatically, and generate reports at the press of a button. They reduce the time required to process transactions and minimize errors. They also make it easier to retrieve information and to analyze data. Enterprise resource planning systems integrate accounting with other business functions. These systems maintain a single database that is used by all parts of the organization. Sales, production, inventory, purchasing, and accounting are all connected. When a sale is recorded, the system automatically updates inventory, recognizes revenue, and records the amount due from the customer. This integration eliminates the need to enter the same information multiple times and ensures consistency across the organization. Database technology allows vast amounts of accounting data to be stored and analyzed. Queries can be run to extract specific information. Trends can be identified. Patterns can be detected. This capability supports more sophisticated analysis and decision-making. It also enables organizations to comply with increasingly complex reporting requirements. The role of accountants continues to evolve. Routine transaction processing is increasingly automated. The focus of accounting work has shifted toward analysis, interpretation, and strategic support. Accountants are expected to understand not only accounting principles, but also the business environment, technology, and regulatory requirements. They serve as advisors to management, helping to interpret financial information and to make decisions that improve organizational performance. Ethics remain central to the accounting profession. Accountants have access to sensitive information. They prepare financial statements that are relied upon by investors, creditors, regulators, and others. The trust placed in accountants requires that they act with integrity, objectivity, and professional competence. Professional codes of ethics articulate these expectations and provide guidance for handling ethical dilemmas. Violations of ethical standards can result in disciplinary action by professional bodies and can damage the reputation of the profession as a whole. Accounting scandals periodically shake public confidence. Cases where companies have manipulated financial statements to mislead investors, where auditors have failed to detect fraud, where executives have enriched themselves at the expense of shareholders. These scandals lead to calls for reform, for stronger regulation, for greater accountability. They serve as reminders of the importance of ethical behavior and of the need for vigilance in maintaining the integrity of financial reporting. Regulatory responses to scandals have included new laws and regulations. The Sarbanes-Oxley Act in the United States, enacted in response to accounting scandals in the early 2000s, imposed new requirements on companies and auditors. It mandated internal controls over financial reporting, increased penalties for fraud, and established a new oversight body for auditors. Similar reforms have been enacted in other countries. The goal is to restore confidence in financial reporting and to reduce the risk of future scandals. Globalization has increased the importance of accounting harmonization. Companies operate across borders. Investors hold securities in multiple countries. Comparability of financial information across countries facilitates investment and reduces costs. International financial reporting standards, developed by the International Accounting Standards Board, are now used in many countries. They provide a common accounting language, though differences in interpretation and application remain. The principles-based versus rules-based debate is ongoing in accounting standard setting. Principles-based standards provide general guidance and rely on professional judgment in applying them to specific situations. Rules-based standards provide detailed rules for particular circumstances. Principles-based standards are seen as more flexible, but may lead to inconsistency. Rules-based standards provide more detailed guidance, but can become complex and may not cover every situation. Most accounting standards contain elements of both approaches. Sustainability reporting is an emerging area. Organizations are increasingly expected to report not only financial performance, but also environmental and social impacts. Metrics related to carbon emissions, resource use, labor practices, and community engagement are being developed. The challenge is to make these metrics reliable, comparable, and useful. Accounting principles developed for financial reporting are being adapted to this new domain. The accounting treatment of intangible assets has become more important as economies have shifted toward knowledge-based industries. Intangible assets, such as brands, patents, customer relationships, and software, are valuable, but do not have physical substance. Accounting standards specify conditions under which intangibles can be recognized as assets. Generally, an intangible can be recognized if it is identifiable, controlled by the entity, and expected to generate future economic benefits. Measurement of intangibles is challenging, as market prices are often not available. Goodwill arises when one company acquires another for more than the fair value of its identifiable net assets. The excess is recorded as goodwill, representing factors such as the acquired company's reputation, customer base, and workforce. Goodwill is not amortized, but is tested periodically for impairment. If the value of the reporting unit to which the goodwill relates has declined, an impairment loss is recognized. This testing requires estimates of future cash flows and discount rates, making it subjective and open to judgment. Fair value measurement has become more prevalent. Many financial instruments are now measured at fair value rather than historical cost. This provides more relevant information about current value, but introduces volatility into financial statements as fair values change. Estimating fair value for items that are not actively traded requires models and assumptions. The reliability of these estimates is a concern, particularly during periods of market stress when observable prices are not available. Hedge accounting allows companies to match the accounting treatment of hedging instruments with the items being hedged. For example, a company that expects to make a purchase in foreign currency might enter into a forward contract to lock in the exchange rate. Without hedge accounting, gains or losses on the forward contract would be recognized immediately, while the purchase is not yet recorded. This creates volatility. Hedge accounting allows the gains or losses on the forward contract to be deferred and recognized when the purchase occurs, providing a better match. Accounting for stock-based compensation has been contentious. When companies grant stock options or shares to employees, should this be recognized as an expense? If so, how should it be measured? Stock options give employees the right to buy shares at a specified price in the future. The value of this right depends on factors such as the current stock price, the exercise price, the time until the options expire, and the volatility of the stock price. Models such as the Black-Scholes model can be used to estimate this value. Recognizing stock-based compensation as an expense reduces reported earnings, but provides a more complete picture of the cost of employee compensation. Related party transactions require disclosure. When a company transacts with parties that have a close relationship with it, such as subsidiaries, key management personnel, or major shareholders, there is a risk that the terms of the transaction may not be arm's length. Disclosure of such transactions allows users of financial statements to assess whether they might affect the company's financial position or performance. Segment reporting provides information about different parts of a company's operations. A diversified company may operate in multiple industries or geographic regions. Users of financial statements may want to understand the performance of each segment. Segment reporting disaggregates financial information, showing revenues, expenses, and other measures for each reportable segment. This enhances transparency and aids analysis. Off-balance sheet financing refers to arrangements that keep liabilities off the balance sheet. Companies have sometimes used such arrangements to improve the appearance of their financial position. Accounting standards have been tightened to require more items to be recognized on the balance sheet. Lease accounting standards, for example, now require most leases to be recognized as assets and liabilities, whereas previously many leases were treated as operating expenses without balance sheet recognition. Earnings management is the use of accounting techniques to produce financial statements that present an overly positive view of a company's performance. It can involve aggressive revenue recognition, deferring expenses, or manipulating estimates. While staying within the letter of accounting standards, companies may make choices that paint a misleading picture. Earnings management undermines the reliability of financial information and is considered unethical by the accounting profession. Auditors are trained to look for signs of earnings management and to challenge aggressive accounting choices. Forensic accounting applies accounting skills to legal matters. Forensic accountants investigate fraud, analyze financial evidence in litigation, and provide expert testimony in court. Their work requires not only technical accounting knowledge, but also investigative skills and an understanding of legal processes. Fraud often involves sophisticated schemes to conceal misconduct, and forensic accountants must trace transactions, reconstruct records, and identify discrepancies. Taxation requires specialized accounting knowledge. Tax laws are complex and change frequently. Tax accountants help individuals and businesses understand their tax obligations, prepare tax returns, and plan transactions to minimize tax liabilities within the bounds of the law. Tax planning involves understanding how different structures and timing of transactions affect taxes. It requires staying current with changes in tax laws and regulations. Accounting education has evolved to meet changing demands. University programs now include not only technical accounting courses, but also courses in ethics, communication, information systems, and business strategy. The goal is to produce well-rounded professionals who can adapt to a changing environment. Professional certification, such as becoming a certified public accountant, requires passing rigorous examinations and meeting experience requirements. Continuing professional education is mandatory for maintaining professional certification. Accountants must keep their knowledge current by attending courses and seminars on new accounting standards, tax laws, technologies, and other developments. This ensures that professionals remain competent throughout their careers. The accounting profession has become more diverse. Efforts have been made to increase the representation of women and minorities. Diversity brings different perspectives and experiences, enriching the profession and improving decision-making. Professional organizations have implemented programs to support diversity and inclusion. Technology continues to disrupt accounting. Artificial intelligence and machine learning are being applied to tasks such as transaction processing, anomaly detection, and audit procedures. Blockchain technology offers the potential for more secure and transparent record keeping. These technologies may reduce the need for certain types of routine accounting work, but will create demand for new skills, such as data analytics and systems design. The future of accounting will likely involve greater integration of financial and non-financial information, increased use of real-time data, and more emphasis on forward-looking information. Accountants will need to be comfortable with technology, data, and uncertainty. The core principles of accounting, accuracy, integrity, and relevance, will remain central, even as methods and tools continue to evolve. Accounting serves a vital function in modern economies. It provides the information necessary for markets to function, for investors to allocate capital, for managers to run organizations, and for regulators to oversee compliance. Without reliable accounting, economic activity would be far less efficient. Trust would be harder to establish. Resources would be misallocated. The mundane work of recording transactions, preparing statements, and conducting audits underpins the functioning of the entire economic system. The history of accounting is a history of responding to needs. As societies became more complex, as trade expanded, as organizations grew larger, accounting practices adapted. New techniques were developed. Standards were established. The profession organized itself. Each generation built on what came before, refining methods and expanding the scope of what accounting could do. The continuity is remarkable. The basic principle of creating a written record of a transaction, established thousands of years ago by Mesopotamian scribes, persists in modern computerized accounting systems. The tools have changed. The speed has increased. The complexity has grown. But the fundamental purpose remains the same: to provide reliable information about economic activities. Accounting is detail-oriented work. It requires patience and precision. A single error in recording a transaction can propagate through financial statements, distorting the picture they present. Accountants check and recheck figures, reconcile accounts, verify calculations. The work is often repetitive, following established procedures and routines. But this repetition ensures consistency and reliability. The trust placed in accountants is earned through consistent adherence to standards and ethical principles. Shortcuts and compromises undermine this trust. The temptation to manipulate figures, to present a more favorable picture than reality warrants, must be resisted. Professional integrity requires that accountants report information faithfully, even when the truth is uncomfortable or inconvenient. The role of accounting in corporate governance has received increased attention. Good governance requires accountability and transparency. Accounting provides the information necessary for boards of directors, shareholders, and other stakeholders to hold management accountable. It enables oversight and informed decision-making. Weaknesses in accounting are often weaknesses in governance. Accounting information is used by a wide range of parties. Investors use it to decide where to allocate capital. Creditors use it to assess creditworthiness. Employees use it to understand the financial health of their employer. Governments use it to administer taxes and regulations. Suppliers and customers use it to evaluate business relationships. The widespread reliance on accounting information underscores its importance. The limitations of accounting must also be recognized. Financial statements are historical. They report what has happened, not what will happen. They are based on estimates and judgments. They may not capture all relevant information, particularly qualitative factors such as management quality, employee morale, or brand strength. Users of accounting information must understand these limitations and use the information appropriately. Accounting operates within a framework of assumptions and conventions. The going concern assumption holds that the entity will continue to operate for the foreseeable future. The monetary unit assumption holds that transactions can be measured and recorded in monetary terms. The periodicity assumption holds that the life of an entity can be divided into periods, and that performance can be measured for each period. These assumptions simplify the accounting process but may not always align with reality. Accounting is both an art and a science. It applies systematic methods and follows rules, which is the scientific aspect. But it also requires judgment and interpretation, which is the artistic aspect. Determining the useful life of an asset, estimating uncollectible receivables, assessing whether contingent liabilities should be recognized. These decisions require judgment, informed by experience and professional expertise. The globalization of business has made accounting more complex. Multinational corporations operate in dozens of countries, each with its own legal and regulatory environment. Consolidating the financial results of entities in different countries, accounting for foreign currency transactions, complying with different tax regimes. All of this requires coordination and expertise. The pace of change in the business environment challenges accounting. New business models emerge. Financial instruments become more complex. Technology enables new forms of transactions. Accounting standards must keep up with these developments. Standard setters work to address new issues, but there is often a lag between the emergence of a practice and the development of guidance. Accounting is a service profession. Accountants serve clients, employers, and the public interest. Balancing these different interests can be challenging, particularly when they conflict. An auditor must serve the interests of shareholders and the public, even if this means challenging the management that hired the auditor. Maintaining independence and objectivity is essential. The accounting profession is self-regulating to a significant extent, though subject to government oversight. Professional bodies set standards, administer examinations, and enforce codes of conduct. This self-regulation is based on the idea that professionals are best positioned to understand the technical and ethical requirements of their work. But the privilege of self-regulation comes with the responsibility to act in the public interest. Accounting research contributes to the development of the profession. Academics study accounting practices, test theories, and evaluate the effects of accounting choices. Their research informs standard setting and helps practitioners understand the implications of different approaches. The relationship between accounting practice and accounting research is dynamic, with each informing the other. The recording of transactions is the foundation of accounting. Each entry in the books captures an economic event. These entries accumulate into accounts. The accounts are organized into financial statements. The statements are analyzed and interpreted. The entire process rests on the accurate and timely recording of each transaction. Throughout history, the methods and tools have changed, but the need for record keeping has remained constant. From clay tablets to paper ledgers to electronic databases, the form has evolved. but the function is the same: to create a reliable record that can be consulted and verified. This reliability is what makes accounting valuable. Without it, the numbers would be meaningless. The standardization of accounting practices has been a gradual process extending over more than a century. In the early days of modern accounting, each company could choose its own methods. One company might value inventory using one method, while another company in the same industry used a different method. This made comparison difficult. Investors and creditors could not easily assess relative performance. The lack of standardization also created opportunities for manipulation, as companies could choose methods that made their results look better. Professional accounting bodies began to issue guidance on best practices. These were not initially mandatory. They were recommendations, suggestions about how particular items should be treated. Over time, as the recommendations gained acceptance, they became more authoritative. Companies that did not follow them risked criticism and loss of credibility. Auditors refused to certify financial statements that deviated significantly from accepted practices. The stock market crash of 1929 and the subsequent Great Depression prompted calls for greater regulation of financial reporting. Many investors had lost money, and there was a perception that inadequate or misleading financial information had contributed to the losses. Governments responded by requiring companies to file financial statements prepared according to specified principles. Independent auditors were required to examine these statements and certify that they conform to the required standards. The development of accounting standards became more formalized. Committees were established to deliberate on accounting issues and to issue pronouncements. These committees included representatives from public accounting firms, from industry, from academia, and from the investment community. The process involved research, discussion, drafting of proposed standards, solicitation of comments from interested parties, and final approval. The goal was to develop standards that were technically sound, practical to implement, and responsive to the needs of users of financial information. Accounting standards are often voluminous and detailed. A single standard might run to hundreds of pages, covering definitions, recognition criteria, measurement principles, presentation requirements, and disclosure requirements. The detail reflects the complexity of business transactions and the desire to provide clear guidance. But the detail can also make standards difficult to understand and apply. Small and medium-sized entities may find the standards overwhelming, leading to calls for simplified frameworks for smaller organizations. The tension between consistency and flexibility is ongoing in standard setting. Consistency promotes comparability and prevents manipulation. If all companies use the same methods, users can compare financial statements with confidence. But rigid rules may not fit all circumstances. Business transactions are diverse and constantly evolving. Standards that are too prescriptive may force companies to apply treatments that do not reflect economic reality. Flexibility allows for judgment and adaptation, but too much flexibility undermines comparability. Disclosure has become increasingly important. Even when precise measurement is difficult, disclosure of relevant information allows users to make their own assessments. Notes to financial statements, once brief and perfunctory, have grown extensive. They explain accounting policies, provide breakdowns of aggregated amounts, describe risks and uncertainties, and present information about commitments and contingencies. Reading and understanding these notes requires time and effort, but they provide essential context for interpreting the financial statements. The audit function provides independent verification of financial statements. An auditor examines the company's records, tests the accuracy of reported amounts, and assesses whether the financial statements are presented fairly in accordance with accounting standards. The auditor's opinion adds credibility. Investors and creditors rely on audited financial statements more than unaudited ones. The audit is not a guarantee. Auditors do not examine every transaction. They use sampling and other techniques to obtain reasonable assurance that the statements are free from material misstatement. But there is always some risk that errors or fraud will not be detected. Audit procedures have evolved over time. Early audits focus primarily on checking arithmetic accuracy and detecting fraud. Modern audits are risk-based. The auditor assesses where the risks of misstatement are greatest and concentrates effort on those areas. This requires understanding the company's business, its industry, its internal controls, and the judgments involved in preparing the financial statements. Auditors use analytical procedures, comparing current results to prior periods, or to industry benchmarks to identify unusual patterns. They also perform substantive testing, examining supporting documentation for transactions and balances. Independence is critical for auditors. If an auditor has financial or personal relationships with the client that could impair objectivity, the credibility of the audit is compromised. Rules and regulations restrict the services that audit firms can provide to audit clients. For example, an audit firm generally cannot perform bookkeeping or certain consulting services for a company it audits. Partners and employees involved in audits are restricted in their financial dealings with audit clients. These restrictions aim to ensure that auditors can exercise independent judgment without conflicts of interest. The expectation gap refers to the difference between what the public expects from auditors and what auditors actually do. Some people believe that auditors guarantee the accuracy of financial statements, or that they are responsible for detecting all fraud. In reality, auditors provide reasonable, not absolute assurance. They are not responsible for preparing the financial statements, and they cannot detect all fraud, particularly fraud involving collusion or management override of controls. Efforts to educate the public about the nature and limitations of audits aim to narrow this expectation gap, but misunderstandings persist. Internal audit is a separate function within organizations. While external auditors are independent and report to shareholders, internal auditors are employed by the organization and report to management or the board of directors. Internal auditors evaluate and improve the effectiveness of risk management, control, and governance processes. They conduct reviews of operations, assess compliance with policies and regulations, and recommend improvements. Internal audit provides ongoing assurance and helps organizations identify and address issues before they become significant problems. Risk management has become more integrated with accounting and financial reporting. Organizations face various risks: market risk, credit risk, operational risk, compliance risk, reputational risk. Identifying, assessing, and managing these risks is essential for long-term success. Accounting systems capture information relevant to risk management. Financial statements disclose material risks. Risk management frameworks often use accounting data as inputs. The integration of risk management and accounting provides a more comprehensive view of organizational health. Accountability extends beyond financial matters. Organizations are accountable to multiple stakeholders: shareholders, employees, customers, suppliers, communities, and society at large. Non-financial reporting aims to provide information about how organizations are meeting these broader responsibilities. Sustainability reports, corporate social responsibility reports, and integrated reports combine financial and non-financial information. The goal is to provide a more complete picture of organizational performance and impact. The accountant's role in these broader reporting efforts is evolving. The skills developed in financial accounting, precision, verification, systematic documentation, are applicable to non-financial reporting. Accountants are increasingly involved in designing systems to capture non-financial data, in establishing metrics and targets, and in providing assurance over non-financial information. This extension of accounting beyond traditional financial matters reflects the changing expectations of what organizations should report. The profession has become more specialized. Some accountants focus on auditing. Others specialize in taxation, in management accounting, in forensic accounting, in government accounting, in not-for-profit accounting. Each specialization requires specific knowledge and skills. Certification programs exist for many specializations, providing credentials that demonstrate expertise. This specialization reflects the breadth and complexity of accounting. No single individual can be expert in all areas. Accounting serves its purpose quietly and continuously. Transactions are recorded daily. Books are closed monthly, quarterly, annually. Statements are prepared and distributed. Audits are conducted. The routine nature of this work can obscure its importance. But without it, the functioning of organizations and markets would be severely impaired. The mundane task of keeping accurate records enables the complex economic activities that define modern life. This brings our story to an end. Sleep well.